Hello and welcome to CanadianAgMarkets.com. My name is Brian Como with Ireland Como Lafoy. A bit of a risk-off day today in markets, so let's get into what's been happening today in the markets. We saw canola down $9.40 a ton to 6.87. That's over the July futures. We saw Minneapolis wheat down 4 cents at 5.92 and three quarter. Kansas wheat was down 8 and three quarter to 5.31. Chicago wheat down 5.5 to 5.25 and a half. Soybeans down 9 and three quarter at 10.52 and three quarter. Corn down 13 cents today. Big drop in corn today. Now at 4.70 and a quarter, and the Canadian dollar still trading right around 72 and a quarter or 72.18 at the time of this recording. All right, let's start with crude oil today because I think it was a bit of a driver for the rest of the market. Crude oil extended some losses today at one point, moving below $60 a barrel over the June futures. Worries about the upcoming OPEC plus supply increases, while also worrying about demand being affected by tariffs, recession, and global economic malaise. There's concerns that OPEC will give the green light on another large output increase in June, and this triggered some moves in other markets, particularly as we move into what could be an oncoming recession here, particularly in the U.S. That spilled over into soybean oil. We saw some losses in soybean oil today. Vegetable oils have an increase or are being increasingly being placed in part inside the energy sector. Soybean oil, which has been moving in a bullish fashion since late March, it did correct today, falling below 49 cents per pound during the session. We are also seeing weakness in vegetable oils in Malaysian palm oil or palm oil. That pushed lower, closing at 3,888 ringgit or Malaysian ringgit per ton. This is the lowest close since October, although there still is trade below this as far as support goes. But this is definitely the lowest close that we've seen in some time. This still feels like a market that's under pressure and is continuing to put pressure on the other vegetable oils. Euronext rapeseed also is trading, towards the low end of its range. It's been range bound for quite some time now, or at least since the end of March, beginning of April. We're now moving towards the lower end. And this, of course, is the most liquid Euronext rapeseed contract, which is August, which would actually be their new crop contract, but still the most liquid at this point. All right, that moves us to our own interest here, the July canola, which saw weakness today right from the start of the session until the end. This is unlike yesterday, where canola ratcheted back and forth between a gain and a loss, ultimately closing, more neutral, I would say, yesterday. Today was skewed a little bit more into the lower or bearish territory. We have upgraded our support as we see rising support in the form of a trend line as well as the 20-day moving average. That support now sits at about 675 per ton. So far during this rally, we have not seen more than 2 consecutive days worth of corrective action. So tomorrow may be a tell on whether or not the market feels exhausted by this rally or not. If we see another down day tomorrow, move towards support, it could signal that we're seeing a little bit more weakness in the July canola. If tomorrow we start seeing some support form and we get a nice green candle, that could mean a resumption of the rally and maybe a test back towards that 711. Again, at this point, it's hard to say which way that's going to go. So we have more of a neutral directional bias at this time. Time to plug our reports here. We issue daily commentary every morning, as well as a slew of other valuable reports containing information and strategies that we don't include in these videos. Okay, so on Friday, we issued guidance on adding to or starting new crop canola marketing. So if canola decides it's not going to correct anymore, we may have actually pegged the high with our recommendation this week. We also include some strategies outside of straight cash sales. So we talk beyond just basis contracts, beyond cash prices, beyond just futures contracts. We also talk about risk management strategies with actionable strategies that you can take to the bank. If you want that level of detail, subscribe to our insights by going to canadianagmarkets.com to subscribe. It's only $99 Canadian per month. You can cancel anytime. So go to canadianagmarkets.com/subscribe to subscribe. That link will also be in the description of this video. All right, moving on. We got some wheat stuff to talk about here. Um, this is Chicago wheat. We mentioned yesterday that it made a new low. I'm not going to touch on this too much in today's video, but we did continue to see that break down. This blue line down here south of the 520 mark is that longer term support on the weekly nearby chart. Same kind of thing with Kansas. We kind of saw it move down again to test that same kind of support on the weekly chart down south of 530, or I think it was 529. And maybe in change. So what's happening here is we're starting to see, this last week we saw crop condition ratings improve. We're starting to see some moisture come in. Lots of moisture coming into Oklahoma and the southeast corner of Kansas and the northern part of Texas. There's lots of winter wheat grown there. In fact, I have a map here that kind of shows where some of that is. Here's good Oklahoma rains here. Some of the wheat in northern Texas. Still some rains coming into Kansas. Good conditions in Washington and Oregon and Idaho and things like that, or are they improved week over week in the last crop condition ratings? So the risks around the U.S. winter wheat crop production are waning, and it's causing the market to move lower to new lows. We did touch on that in yesterday's video, so I'm not going to talk about it too much. Here is the Minneapolis wheat futures. We haven't moved to a new low today, but again, I kind of cautioned yesterday that if we continue to see breakdown on the winter wheat side, it'll be hard for Minneapolis to maintain a different technical outlook or a different directional bias outlook than the other wheats. So we're seeing less weakness in the Minneapolis wheat contract than we are in the winter wheat contract, but they're all kind of tied together. So we're seeing weakness in all three of those complexes. Today, corn was a big off day today, and was one of the victims of the risk off move today, particularly I think with the energy sector as it took its toll. RBOB gasoline was lower in trade today, in line with crude oil weakness, or maybe not quite as large, but overall, I think this has kind of had a negative sentiment on anything that's related to energy, which would be ethanol or corn, and vegetable oil, soybean oil, and those types of things. The crop progress on corn, I think it was 24%. Let's see here. Yes, U.S. crop planted 24% as of April 27th, which is ahead of the 5-year average of 22%. Emergence was pegged at 5%, which 1% is normal at this time. So overall, the corn planting progress is ahead of schedule, and that is causing some weakness in the corn market as well. All right, that is all we have for you today. We want to thank you for joining us, and join us again tomorrow for another market update. Have a great day, and again, subscribe at canadianagmarkets.com/subscribe. Have a great day.